Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. Now, if this is your first time listening, be sure to hit that subscribe button so you don't miss an episode. And if you're a returning listener, let us know what you love about the show. Leave us a rating and review so we can make the show work harder for your investing needs. Now, today we've got a great show. We've got a returning guest, Mr. Ivan Barratt. Now, Ivan Barratt is a multifamily owner, manager, and syndicator who specializes in large apartment communities in the Midwest. Since 2015, Ivan has raised nearly $250 million in equity and has acquired over 5,900 units for his company, BAM Companies. Let's welcome to the show, Ivan Barratt.
Hey, John. Thanks for having me. It's good to see you again, man. It's been too long.
Absolutely. Ivan, you were a guest earlier. I want to say like episode 52 or so. So I'm going to confirm that in a moment.
That's
but it's
specific.
Great to get you. I know, right? I feel like it was episode 52. I feel like that sticks out, but I'm going to double check there. But it's great to get you back on. I'd love to hear what you've been up to since our last conversation. I went over your bio at a very high level. Take 2 minutes to fill in some of those gaps.
Well, I'm going to go back to when you and I sat down in Chicago during a conference. We got a few minutes to break away from everybody looking for our time and just chat one-on-one. Really, always enjoy catching up with you. I think I want to say that was maybe 3.5 years ago. It's hard to tell these days with COVID time. We've probably doubled in size since then. We've transacted, like you said, almost 6,000 units. I think at that time I was working on my first fund, going from a single asset syndicator out there to a fund format. And today we're on fund number 3. So that'll, by the end of the year, actually put us to about 300 million in equity that we've raised in-house now with me and my team, all under our roof, several hundred more units. We've sold several since then, had some great exits to throw up on the track record. And I think the best way to put it, John, is the BAM companies have come much closer to being sort of its own organism. You've probably heard me say this. It's almost like my fourth child. BAM's grown up a lot. It's making decisions. It's got a great leadership team. It's growing whethout, my micromanagement every day. It's been so fun to build out this leadership team and this organization, whether on the management side, which is really the key to our success, is our management teams up and down the org chart. As well as BAM Capital, which is charged with stewarding the hard-earned dollars of our investors that come alongside us as partners in those assets that we acquire. So having a lot of fun, still trying to figure out how to keep all these plates spinning sometimes, being a success in business, but also being a good husband, a good father. Trying to stay fit and create some memories while my kids are still young enough that they want to hang out with me.
I love it. And you're right. I mean, we got to sit down back in, I want to say 2018 at the Midwest Real Estate Networking Summit. And you were one of our guest speakers and had a great presentation. It was great to talk to you. And speaking of kind of the Midwest, you're based in Indianapolis. Yeah. I'm here in Cincinnati. I know that we both like the Midwest, but talk to me about your perspective. Why do you like Midwest for multifamily as opposed to maybe the more popular Southeast region or West Coast like Phoenix and Vegas? What is it about the Midwest that attracts you?
So I would say the greatest characterization I could use would be I'm a value investor. I belong to the Warren Buffett camp. I like value a lot more than I like growth. The FANG stocks are sexy when they're going up, and they're absolutely destructive to your portfolio when they come down. Markets like Florida, Texas, cities like Phoenix have throughout history been boom and bust markets. They go way above the mean. They crash through it back down, and you've got these wild market swings. There's definitely operators out there that can make a lot of money in that, but typically when the music stops, there's not enough chairs for all the investors. And so that for me just isn't the way to build a business. I like being the tortoise versus the hare. Midwest specifically, it's still undervalued A lot of people out there still think it's the Rust Belt. They don't realize the diversification of services, technology, e-com is huge here in the Midwest. And so I can find better cap rates. I can find better value, and still get the same sort of value add. It's still all about the value add for guys like you and me. And so it's just a little bit easier to find deals where I know I can achieve investment objectives. For us, we like to do 2 to 2.5x times the investor's capital over 5 to 7 years, sometimes a little bit faster than that. And, in order to do that, you got to buy them right. And you got to have deals where you can still increase rents and reduce expenses to get, that pop in NOI. And there's just a lot of great markets that are under the radar. So I don't have to necessarily work as hard to find deals where I'm not overpaying. There's still plenty of mediocre real estate here in the Midwest, just like everywhere else, right? And it's still really tough to find a great deal. But here in the Midwest, I've found a little niche that's easier to compete in and be confident in delivering my returns, keeping my number one asset intact, which is my track record.
There you go. Well, listen, great insights right there in the Midwest, and we certainly echo.
Don't tell everybody.
Well, I think it's important to understand that there's ebbs and flows in every market. And this is just one of those things you have to figure out for yourself as an investor is what are you comfortable with? And understand that, the good times don't always last, but if you can buy based on value, you can buy based on cash flow, you can hold those assets maybe when the market shifts a little bit, you'll be in a strong position. And that's one of the philosophies that I know you use for your deals is making sure that you're buying cash flowing assets that still have a value add component where you can force appreciation. But because of the cap rates you're buying at and the kind of deals you're buying, you can maybe weather the storm if the market shifts as well. So just really good insights for anyone thinking about market selection. It's not always about, that great growth or the great, increases of rents, because things that go up like that, they tend to have a little bit more volatility on the downswing as well.
That's right. That pendulum goes this way. It's got to swing back the other way, right?
Exactly. It's got to come back both ways. One of the things that you start to hit on is, with your track record and working with investors, you're able to find these great deals. And I know starting out, you were focusing more on what you called single assets or going out there, finding one apartment complex, buying it, putting it in front of investors, raising capital and going out and closing. And you have since kind of moved to more of a fund model. Talk to us about the pros and cons and why did you make the decision to move from single assets to a fund model?
It was an easy decision. So it had been on the drawing board for a long time, or maybe my dream board, right? One day I want to be a fund manager. But the reality became clear later on in 2018 when you and I were talking. So what happened at the end of that year is I got 2 deals that fell in my lap at once. And I needed to raise, don't quote me on this, call it $26 million in 30 days. And at that time, that was a big chunk of change to raise in 30 days. Not so big now, but then it was. And what I ultimately had to do, because I couldn't raise that in 50 to 500K checks in time, is I took one deal and I syndicated it with my stable of investors and new investors. And then I took the other one and I did a joint venture with a private equity firm because I had no other choice. And that was okay, but that really wasn't what I was in the business to do. I like democratizing real estate for the individual investor. And that was my never again moment that, hey, we've got to take this fun thing off the dream board to the drawing board to reality, because I want to be able to have larger pools of capital ready to go when those opportunities come. And I canceled a vacation during that time to raise capital. I canceled a family vacation. And so the process of going to a fund was very difficult, but basically the pros for me was it allowed me to have a longer runway to raise capital and be ready. It made that capital process more efficient. And for my investors, which took a lot of education, I mean, in those days, I was literally on the phone with just about every investor, many of which said, hey, I don't do funds. I only do single asset deals. And I had to convert them from a no to a yes, because the advantages to them were listen, John, you've been with me now for a while, or you've seen my track record. I built this trust. You're going to have to trust me a little bit more, right? That's the little bit of a con versus the pro, that the investor's no longer betting on the deal or underwriting the deal. They're betting on the jockey. They're betting on my team, my sponsorship, and my vested interest in not buying bad deals and screwing over investors, because that would hurt my track record, my future ability to grow capital. The advantages for them were more diversification. So when you're in a fund, you're not taking single asset risk. You're diversified over a portfolio of assets. You no longer have to worry. I'll just pretend you're the LP for a minute here, John. You no longer have to worry if, hey, this is my home run deal, or it's the next deal I got. That, you're going to participate in all the deals coming down the pike. And as you and I know, 5-6 deals in a portfolio, if I stick to my acquisition discipline and I don't just do deals to do deals, a couple of those deals are going to do just what we think they're going to do. One might not do as well, and the others are going to pull that up. And a couple are going to be home runs. And that investor is going to participate in all those. So it did two big things. It decreases the risk to the investor by spreading risk out over a couple thousand units versus a couple hundred. And it increased the probability of a higher return on the back end by participating in those home runs for the investor, no longer having to worry about cherry picking which deals Ivan's best deals and which deals aren't. And also, when you aggregate that many units, you typically can fetch a premium on the sale by offering a much bigger fish out there in the ocean, instant economies of scale in that market. So increasing overall returns, or the probability of a higher overall return, while at the same time reducing risk, that is the definition of alpha. And so we were able to get a lot of momentum, although it took a while. But now, we're on our third fund. One was 50, fund 2 was 75 million, and this one will be between 100 and 125 million.
So let me play that back, because I think there's a lot of great information there. From the LP or limited partner standpoint, one of the benefits of investing in a fund instead of a single asset is you get the diversification. So let's assume that this fund does 5 deals, just to use a number. If the fund does 5 deals instead of just the one, well, now your investment is spread over 5 deals, not just that one single deal. So whether it's the home run deal, whether it's the average deals, you're still going to get that benefit. So that is a great benefit for that investor. Is now they're no longer worried about, is this the right deal, or should I wait for Ivan's next deal? Because that one might be the best one of the bunch. You now have it spread out across all those deals, so you'll get the benefit. The downside or the concern for that LP is, now they're not evaluating that deal on an individual basis. They're really having to trust you as the operator to find and operate excellent deals because they're not going to be selecting them one-on-one. So that's kind of the trade-off in investing in a single asset versus a fund. For the operator, I hear a lot of people.
But don't bet on the horse, John. Bet on the jockey.
There you go. So for the operator, more and more people are moving to a fund model. What concerns or risks should they be aware of before making that transition? Well,
it's normal, I think, where we are in the cycle, to see more operators, more sponsors moving to a fund. Number one, they've seen those of us out there that have led the field and gone that route, right? The fund seems on the maybe off the cuff that it's easier. What I would say to the LP, whether you're evaluating an individual deal or a fund, and I think you should be looking at both. When somebody asks me to look at a deal, when an investor says, "Hey, can you check out this other deal I'm looking at?" I go to the back of the offering and start there and move forward. And the first thing I look at is the management team and their track record. And 99 times out of 100, I don't get past team and track record before I throw a deal in the trash or tell an investor to perhaps throw it in the trash. Trust is so important in a fund. The good sponsors will recognize this, right? Because yeah, sure, fund number one, I could have gone out and bought deals just to buy deals and rip fees, right? But if those deals don't pan out and I miss my investment objectives or my target returns, then it becomes increasingly difficult for me to continue to raise capital. Where if I'm smart and I've got the long ball and I take care of my investors first and I still uphold my acquisition discipline, then I can raise even more capital over time by protecting that track record and delivering those returns. So, people had to bet on me that when it was my first fund, but most of those folks that bet on me early were investors that had already been with me throughout my single asset portfolio deals. And folks, that's the number one way to grow a syndication platform is to take care of those investors, because even to this day, with all the marketing and advertising we do, my single greatest source of investment dollars is existing investors and referrals from existing investors. That doesn't happen overnight, but it's a flywheel. If you're familiar with good to great there, creating your flywheel. If you do it right and you push on it hard enough and you build it, it becomes its own self-sustaining momentum over time. And it doesn't happen right away. But if you're disciplined about it, it's like going to the gym and expecting a six pack, after a couple months of working out. Unless you're John Kasman and you're genetically gifted, it doesn't happen, right? Most things take this daily discipline, and then all of a sudden you wake up 2, 3 years, 4 years down the road, and you're on your third fund for 125 million.
I think you gave some great insights. Let's break it down, because
especially your six pack.
Well, I mean, of course, those are from a bunch of crunches, and I go from a six pack to beer belly all the time. So it's just a matter of what week you catch me. But here's the thing. You gave some great insights from both perspectives, and I want to make sure people really understand and take to heart what you're saying. Let's start with the LP side of it. As a limited partner, if you're considering a fund, you want to bet on the jockey, not the horse. What he means by that is to say, if you have an operator that is performing and you have a great relationship with them and you understand their philosophy, the way they look at deals, they have a clear criteria for how they're going to identify and select properties moving forward, that's a great way for you to partner with them and get the diversification of multiple deals, as opposed to hoping that deal is the deal. Now you're not really betting on just one deal, but you're betting on that operator that, hey, they're going to be able to find deals, and the bulk of them are going to do really well. From the downside, yes, you lose that control of being able to identify each individual deal. But in fact, the benefit is once you find that operator that you like, you really don't have to spend as much time evaluating every single deal, because you know that they're not going to take that risk on their own reputation, because they want to keep that track record intel. With that said, on the flip side, if you're an operator, you said something I want to make sure people caught, because again, I know a lot of people are moving to the fund model, but you said that it was really difficult starting out because a lot of your LPs really didn't want to do that. And in fact, some said, I don't do funds. So you had to have a conversation with them to help them understand where the value was. And what really helped is they had already invested in you and in your deals. They had already seen and experienced that track record, that success, the communication process. They felt comfortable with you as an operator. They just weren't comfortable kind of doing these blind investments on these deals. So they were.
We never use the word blind, John.
Okay, explain that.
It's discretionary. I mean, blind is accurate, right? A better word, if you're an operator, would be discretionary. And you as an operator, we as an operator, just have to prove out that our discretion is something that the investor should bet on, right? We're no longer saying, hey, here's the deal, here's the budget. It's now, hey, we've been delivering 2 to 2.5x. our overall investment thesis is, institutional properties where we can find value add in the Midwest and markets with a great jobs picture, growing rents, on and on. It's more, it's more of that top level summary, right? But yeah, you as an operator, you want to learn the vocabulary of a fund manager. It's not just, hey, all of a sudden we're going to do a fund. There's fund management, fund accounting. One thing we did to build trust with our current investors and new ones is we are audited. Costs, I think, $25,000 per year per fund. But we are audited by a national accounting firm. Not because we like spending money with accountants, but because I can tell John here straight out of the gate, hey, yes, you've got less insight into the individual deals, but you've also got this national accounting firm looking over my shoulder, randomly checking invoices and accounting and the general ledger and auditing those books. So that the investor who may not know me yet, but may be referred to me or came in through an advertising channel, can be more comfortable and gain more trust early on.
And then the way you do your funds, do you call when you have a deal? Do you call for funds at that point, or are they investing and then you put those dollars to work once you find the next opportunity?
Typically, we're raising capital in tranches and deploying in tranches as we find as we identify assets that we can acquire in the fund, and we're calling capital along the way. Sometimes all up front, or sometimes in pieces, depending on how the deal flow looks. And then the investor, no matter what tranche they come in, they own all assets in the fund. It's just the sooner they subscribe and invest, the sooner that preferred return and return profile clock starts ticking, right? So you'll find if some investors want to come in at the end, we offset that incentive. By deploying capital early in the fund, you get a little bit more of a return. So you come in early, your return as expressed as a percentage might be a little bit lower than the person that got in at the very end, but your equity multiple is going to be a little bit higher because your money's been working for a longer period of time than the person that came in at the end.
Makes a lot of sense there. From a communication standpoint, are you sending updates on individual properties? Are you just sending an update on the overall fund's performance? What kind of communication can investors expect?
Yes, all the above. All the above. A big part of this game is being as transparent as you can. The more communication, typically, the better. Allowing investors, especially in the beginning, if there's not a lot of cash flow coming off of value add deals, allowing them some insight into how you're adding value and what the unrealized gains on the projects are. That helps drive repeat investment, helps drive referrals. Is being very communicative. It is critical to being a fund manager and growing. Now to almost 700 investors, maybe 1,000 by the end of the year, to have a really good investor experience team. But at the same time, always being diligent about little continuous improvement daily. How do we get better at this? There's always a way to get better. How are we getting better here? Who's the next key hire? How can we make the system better? How can we be even more transparent than we were yesterday and 6 months ago and a year ago? And I stole this from Jeff Bezos, but the better I can do at being transparent with my investor, the good, the bad, the ugly, hold periods, our style, our thesis, all that, then the investor it becomes less salesy. Now the investor can self-select if I'm a good jockey for their stable, if I'm a good, investment for their portfolio. And we work really hard at that. And it doesn't pay off overnight, but over time, you really see the difference it makes.
Makes a lot of sense there. For the operator who is considering this path or already down this path, what's something they need to know about the difference between being a fund manager and a syndicator? You talked about the vocabulary of already, but beyond the vocabulary, what's something else they need to understand that's a difference for a fund manager versus just being a syndicator?
Yeah, I don't know. You can push me on this if this isn't a good enough answer for you, John. I'll try again. But I think there's some folks out there that are trying to skip steps by going straight to funds, and that's a difficult, if not impossible, road if you don't have proof of concept first. So I would say to anybody coming up through the game, you really need to do some deals, raise some capital, put a whole deal together, and you need exits. You need deals that have gone full cycle and you've returned capital to investors and met or exceeded your business plan. And you got to build up that stable of investors that trust you before making the leap to the fund. All these things have steps, right? You gotta crawl before you walk, and you gotta walk before you run. And I see a lot of eager entrepreneurs out there maybe being a little too impatient. For those that are ready to leap to a fund, it's a whole nother education process. It's learning the vocabulary. It's learning what it takes from legal and accounting to pull this off. And make no mistake, it is a lot of heavy lifting on you and your team. If I'm a one-man show and I'm just partnered with some other syndicators, that's a great way to get into this business and get moving. To get up into the fund level, you need a business, you need an operating team, you need employees. That's some expensive overhead that needs to be paid for somehow, some way. And maybe there's other ways to do that, but that's my opinion on some of what it takes to graduate up to fund manager.
No, I appreciate that, Ivan. For our listeners who want to learn more, you can check out Ivan and his company at bamcompanies.com and also BAM Capital. So if you're interested in investing, go to bamcapital.com.
BAM Cap Group.
BAM Cap Group. Sorry.
BAMCapGroup.com.
Yep. All right. Ivan, you're launching your third fund. And I know that this is one where you're focusing on a recapping of assets. For people who are not familiar with that term, what exactly is that?
So it's interesting, and it's been another tremendous lift of effort and education to help investors understand this, because this happens a lot in our industry at higher levels, but doesn't happen a lot down here yet. I think it will. It'll be another trend. But what's happening right now in one of my portfolios is I have the opportunity to sell the assets, return in excess of our business plan to those original investors, return above what we said we were going to do in a shorter amount of time. But instead of selling that to somebody else, I'm actually buying it with a new group of investors. I'll stay in as the sponsor. It'll be treated like an arm's length transaction or a separate transaction. So new debt, new appraisals, new contracts, new underwriting, everything. But we will be the sponsor again, because what's changed, at least in my market, is I've got this opportunity to take these deals, recapitalize them with new debt and new equity, and make physical improvements to the properties that we didn't make on the first turn, which will allow us, in most cases, to raise the rent between $200 and $400 per unit per month. And the evolution of that was, coming out of COVID, and because my funds are audited, we do a national BOV, a broker's opinion of value, every year for the audit. And we started looking at where values were, and it wasn't just cap rate compression, but we had optimized a lot of the expenses. We were able to increase rents without doing any physical improvements, just because of the market. And again, I really want to stress we added a lot to the NOI by reducing expenses. We've got a great management arm. Values and a little bit of cap rate compression in our market. Values went up to where we could sell them and return 2x capital to our investors in about 2 years versus 5. Tremendous IRR. Well, we looked at doing that. And then we got all these letters of interest from big investors. When I say big investors, I mean like groups, like family offices, institutions that will write one check for $90 million. They said, hey, we'll buy them. You stay on as the partner, right? You manage them. You execute the value add strategy. Let us take out all your small investors. And we started looking at that route. And then it really dawned on me and Adam, my business partner, like, hey, we've been doing this in-house for years. We've been democratizing real estate for the individual investor. Why would we not raise that capital in-house with our own stable of growing investors versus going to the big guys and hitting the easy button? And so we decided to go down this route, which has proven even harder than I would thought, to educate everybody, because it's a fine line. I have to do right by my first fund and make sure that they get a return in a market price sale. And then I have to educate fund number 3 on why we can buy at a market rate and still force the appreciation enough to double their capital over the next 5 to 7 years. And so it's taken a lot of investor handholding. I did a 90-minute deep dive webinar on this whole thing. And we're off to the races. We'll be closing on a couple of those first transactions here shortly, and I'm excited to infuse those deals with new capital, make these improvements because of the market conditions we're in right now. And I think we're going to see more of this recapitalization, because why would I go out and find new deals right now in this environment when the best deals for me to acquire and have the highest degree of confidence in returning 2 to 2.5x to my LPs in 5 to 7 years are already in my portfolio?
I think that's a great strategy for a couple of reasons. One, it's really difficult to find great value add deals in this market. And if you have a property you already own and manage, you know where the opportunity is to increase the value and what's going on with that property.
More than anybody else.
More than anyone else can. And it also gives you a leg up, because if you can recapitalize, you know exactly how you would redeploy those funds. So I think it's great, right? You're not competing,
and if you're an
right?
investor listening, again, my track record, guys, is still my most important thing. I wouldn't do this if I thought it was going to screw up returns. I've worked too hard to get this far to just do deals to put fees in my pocket. I have to deliver returns on a recap, or my stock value as a jockey goes way down.
Let me ask you this, because one of the questions I have is, if I'm an LP in that original deal, is there an opportunity to either 1031 exchange or to stay in on the new deal? Like, what happens to me if I like the deal and I like the recapitalization strategy and I want to be a part of that?
Yeah, there absolutely is. The 1031, we spent probably $12,000 in accounting fees out of our own pocket to study that with our accounting firm. And the cost and complexity of it just didn't make sense, given that the goal is still to exit those assets 5 years from now. So the tax savings is nominal. Now, remember, when I do a recap and it's a new transaction, I also get to do cost seg all over again. So we can eliminate most of the tax burden by cost seg and accelerated depreciation on the new transaction.
I love it. I love it. Listen, if investors want to learn more about that, again, say the website again. I know I messed it up the first time. And in fairness, I asked Google, you before we hit record what the website was.
You did. It was all me.
It wasn't me. All right. So what's the website for people to go to? Yeah,
we're not hard to find. Google my name right there. The BAM companies or BAM Capital, BAM Cap Group will get you there. BAMCapGroup.com. But we make ourselves pretty easy to find. I think we're at the top of the list right now for multifamily syndication as well.
I love it. I love it. All right, Ivan, we're going to go to a round of insights. You ready?
Oh, here we go.
Give me a failure or an apparent failure that set you up for later success.
Best one was 2008. The great financial crisis was the single greatest gift of my real estate career. Was young enough to learn a lot of lessons. Didn't feel good at the time, But I'm so thankful and I feel blessed that I learned it at a young age. Forever changed my DNA as a real estate operator and investor.
Give me a digital or mobile resource you recommend for your business.
We've been on Slack since 2014. That's kind of played out. A lot of people are on that now, but I'm still a huge fan. It's big for our culture. I think as an operator, it's important for me to be financially educated and continue my financial education. This is going to dovetail with my book recommendation, but I think the Real Vision platform, you can get some of their insights for free on YouTube. Fantastic informational platform for macroeconomics, geopolitics, real estate, crypto, what's going on in the world. And they're only selling you the platform. They've got all kinds of dissenting commentators on there arguing all kinds of different viewpoints. They're not trying to sell you gold or real estate or stocks or anything else. It's a fantastic.
And it's Real Vision.
Real Vision. Yep. You can find it on YouTube, realvision.com. One of my favorite sources for staying up to speed and educated as a fund manager and investor operator.
All right. And speaking of the book, what's the book you've recommended or gifted the most in the last year?
Oh man, Turning the Flywheel, which is a much smaller book than Good to Great, but it's all about finding your flywheel. That's a great one for entrepreneurs. What I like to tell real estate guys is, take a screenshot here. These are some of my most influential books in my journey, and you'll notice that only a couple of them are real estate books. Most of them are entrepreneurship, markets in general, demographics, growing a big company. Once you get so far in real estate, it's more about these other facets of growing a business and being a smart investor operator than it is, buying another real estate book.
What's a daily habit that helps you stay focused on your goals?
Journaling. It's not daily, but I believe, if I had a time machine, I would have gotten involved in peer groups and in one-on-one business coaching much earlier in my career. Big fan of that. That cadence keeps me on my goals. And personal trainer coming to my house, kicking my, a few times a week, makes it very hard to miss workouts.
Well, it's hard to miss it if that person's at your front door. So
he's showing up, man. He's showing up to murder me some days.
I love it. All right. What's your number one What's your number one insight for investing?
I don't think there is just one insight for investing. I guess the way to answer that, John, would be it's so important for the investor to get as educated as they can. I'm a big believer in financial education. I get asked all the time, what's a good deal look like, or how do I get started? And I like to tell people often, look at so many deals that you know the answer to that question. Repetition is still key. When I went out to buy my first rental property, I looked at 50, 60 rental deals before I bought one.
I love it, man. It's great insight there.
I hope so.
Last question here. You're in Indianapolis, and I'm going to check, by the way, what actually I have it up here. And I was wrong. It was episode 59, not 52. So I was off by 7. It was episode 59. But I've got your answer up here for the first time. What's your favorite place to grab a bite to eat? You got my answer from the first time? I have your answer from the first time. You're not going to tell me though. I'm not going to tell you until after you answer. So I moved to Carmel, Indiana, which is a really nice suburb to the north of the city. Monterey has been my favorite place to go. Best sushi joint in the whole city. Seafood, freshest food, great bar selection, fantastic service. And downtown Carmel has just done a phenomenal job of creating a suburban, urban feel. I love it. Monterey is the answer, and we'll make sure we check that out next time we're in Indianapolis. What did I say last time? Your answer last time was Spoke and Steel. Oh yeah, dude, in the city. Still, I'm going there in a month, man. It's still a great spot. There you go. Excellent. Well, listen, Ivan, I love our conversation. You gave us a lot of great insights. I appreciate how you talked about why you still love the Midwest and talking to us about going from the single asset model to the fund model, some of the things that LPs need to understand and some of the things that general partners or operating partners need to understand as well to make that switch. And then really why you are recapitalizing your current deals and rolling that for new investors. I think there's a lot of information there. And if folks want to learn more, they can check you out by going to your website, Spam Companies. And if they want to learn more, just check out Ivan there. I just want to thank you again for taking the time to come on Multifamily Insights. It's been a pleasure talking to you, and we hope you have a great day.
Right back at you, John. Thank you for having me.